Hello everyone, thank you so much for joining me today. For today's video, I want to get you caught up on some of the things I'm looking at from an auto market perspective, both globally and in the United States. Some very interesting breadcrumbs are starting to appear and some broader trends are becoming way more clear because some of the data that we're seeing out in the market. So without further ado, let's go ahead and get started. This morning, there was an article from Reuters. Electric vehicle maker Polestar lowers production guidance and cuts jobs. This is Polestar 2 from the brand that's also a partner with Volvo. They're independent from Volvo, but it's a partnership with them, and this is their pure electric vehicle called the Polestar 2. They also had a Polestar 1 and a Polestar 3, which is an SUV shape. Some of the things in the article that I want to highlight: Swedish electric vehicle maker Polestar lowered its 2023 production guidance on Thursday. It would cut headcount by about 10%. And decided delayed production start for its Polestar 3, which is that SUV, and a challenging environment for the industry. And this is sort of like an interesting sort of snippet from the article that I really want us to focus on. They said that they now expect to produce somewhere between 60 to 70,000 cars versus the previously predicted 80,000 for 2023. And some of the things cited in the article by Reuters that could be causing them to do this is an ongoing price war started by Tesla and higher interest rates, which has put a further squeeze on cash and people being able to essentially take out loans because it makes loans more expensive. Polestar did about 50,000 in 2022, and their guidance for 2023 is somewhere between 20% to 40%, 20% being the low end and 40% being the high end. But that growth is obviously good for the company, but it's interesting that they lowered their guidance based on some of the things that they cited. And so from that standpoint, I started digging around and seeing, okay, what does that mean within the context of the broader market? What's the rest of the market doing? And is this a signal for something else that's going on? So this is a chart that was posted on Twitter. The username is XIL_LLIX. I gotta put my glasses on for this sometimes, eh? And this basically breaks down the EV sales by brand for the entire year by year. The red one is Tesla. The one next to it is legacy automakers like Volkswagen, Ford, GM, so on and so forth. The next one is Chinese brands. And then the last one is everything else, others. And then you can see this is for 2020, this is for 2021, and this is for 2022. And you can see how each brand is performing year over year. The real big takeaway here, once you add up all these brands for the entire year, is that the battery electric vehicle growth is at 83% on average year over year since 2020. So if you take the average growth from 2020 through 2022, the BEV growth is 83%, which is a gigantic number. And those trends seem to continue into 2023. The latest report said that Tesla has about 25% market share based on that, but their growth is still there. And Chinese automakers and others should still be growing their brands. So it's 83% year over year, which is a huge number. And so if EVs are growing like mad, is lower guidance a signal? So if we know that the broader EV is growing very rapidly, is an EV company saying, hey, we're not going to sell as many as we thought we're going to make, a signal for something bigger that's going on? And that's really what I want to dig into. And my gut tells me that affordability is likely a big factor as to why this is going on. Automakers that can't make affordable cars are, regardless if they're EV or not EV, they're going to have a tough time growing as fast as they should with the new market dynamics going into the next few years. If we look at the Polestar starting price, this is for the Polestar 3, their SUV. The starting price for this car is about $85,000. And so this is not a cheap car. The Polestar 2 is somewhere underneath that because this is the SUV form factor, but $85,000 for a car. I'm sure it's a phenomenal car, but it's very, very expensive. And so if we look at the broader trends of what's going on in the market, I think we can probably make a good sort of guess or a good hypothesis that automakers that are really making very good affordable cars, especially if they're EV, they're going to enjoy that 80% plus on average yearly growth rate for the next few years. So let's look at the latest Cox Automotive US report that came out this morning as well. A lot of interesting data that points to this. And before we do that, I would love it if you throw me a like. It helps the YouTube algorithm show this to more people. Thank you so much. So here's part of the report. I'll read some of the highlights. The text is small, I apologize, but I will make sure to just go through this real quick and highlight the broader trends. Segments with the highest inventories were a mix of electric vehicles, hybrids, and full-size pickup trucks, plus super luxury vehicles, and this is in the US for dealerships as of the end of April. It should be noted, however, that segments like EVs, hybrids, and as well as super luxury and sports cars can show wild fluctuation in days supply due to low sales volume. Honda Civic had the lowest supply, followed by Honda CR-V, Kia Forte, and Toyota Corolla. And you would notice, if you're familiar with cars, that these are affordable, sort of compact cars, super affordable, sub 30,000 in a lot of cases, or around 30,000 with everything that people usually buy with these cars. But it's way more affordable than, say, a Polestar. Full-size pickup trucks from the Detroit 3, which are GM, Ford, and Stellantis, or Ram, had the biggest supply. The Ford F-150 had the most days, the most at 99 days supply, which basically means that it takes 99 days to clear the lots. The average is around 60. That's where automakers want to be at, followed by the Ram 1500, another pickup truck, and the Chevy Silverado, another pickup truck. Lower price categories had the tightest supply by the end of April, meaning the lowest level of supply, lowest number of days on hand. New vehicles priced between $20,000 and $40,000 had days supply of 41 or less, which is significantly lower than the 60 that automakers want to be at. The 40 to 50,000 category had 50 days supply, and this is the very important one. The $50 to $80,000 category had day supply of more than 70. So you have a category that's below the 60, and then you have a category that's above the 70. So let's analyze this a little bit further and kind of think about what are some of the trends that could be emerging from this article, from this study, and see if we can sort of tie some dots, connect some dots, as some people would say, and see where this goes. So legacy EV and hybrid demand is much lower than obviously automakers anticipated from the Cox report. Some of the vehicles that had the highest day supply were tagged as EVs and hybrids. Now I say legacy because the only automaker that doesn't use the dealership network is Tesla, and Tesla wouldn't be included in this report. Legacy EV and hybrid demand is much lower. So these are cars like the Ford Mach-E, the Volkswagen ID4, the Hyundai Ioniq 5, the Toyota Prius, so on and so forth. These are being cited as having the highest on-hand inventory in U.S. auto dealers as of the end of April. My gut tells me that Tesla's price decreases likely are having a very large effect. And the reason why is if you analyze Tesla's lowest model that they offer today, the Model 3 rear-wheel drive, it starts at $40,240, but you can also get an EV tax credit on top of that, which brings the net price to $36,490. And this was a giant change from where Model 3 was at in 2022, where the starting price was $48,400 before Tesla had their massive price decrease on top of the EV tax credit that they weren't getting before 2023. So you've had this $20,000 basically gap appear in pricing to the lower side, which is likely impacting that trend with the EV legacy automakers and the hybrids, in my opinion. And so this is a trend that we should be keeping our eye on moving forward. If there's no further adjustments from legacy automakers, or if this sort of gap starts to widen, then we will have confirmation that says, hey, these price decreases are having a large effect. And we should see this by Tesla sales going crazy and then legacy EVs and hybrids going down. As those two things happen, we know that the pricing is going to be by far the largest factor for those things. So very interesting thing to keep an eye on. Additionally, we talked about price decreases for one specific car. Cheaper cars being bought at faster rate than expensive cars is also a broader trend that's happening in the auto market. If we think back to what the article said, cars that were starting at $40,000 or less, they had a days on hand supply of 41 days or less. And those that started at 50,000 or more, they had a 70-day supply or more at those lots. So this signals that lower priced cars have more demand relative to the higher priced cars. And this also highlights that automakers likely were not expecting this shift in demand. Otherwise, you would think they would have more lower priced vehicles in their lots so that they can really support that demand at that 60-day level that they would like. And then they would ramp down their higher priced vehicles so they wouldn't go over that 60-day limit that they had, that they want to be at on dealership lots. Instead, they're at 70 or more, which is obviously a concerning trend. And then pickup trucks especially are not selling well at all. And we saw that with the data point around the F-150. The Ford F-150 is the best-selling vehicle in the United States, yet it's at 99 days. The F-150, for the longest time, America's favorite truck, America's favorite vehicle, period, but it's at 99 days supply. And pickup trucks are generally quite a bit more expensive than any other type of car. So this is yet another signal that says that affordable cars are in much higher demand, period, than more expensive cars. And tell me in the comments if you feel this as well, as you've thought about your own car buying experience, what you're looking at, what your friends and family and neighbors are saying. I would love to hear more from you if this is actually happening. And so this could also point to the fact that dealerships could be getting greedy. So we know that the legacy automakers utilize the dealership network in the United States to sell their cars. Are dealerships getting now to a point where they're just asking for way too much money? And that's why we're seeing this sort of trend of people saying, screw you, I'm just going to buy a Corolla, screw the F-150, I'm going with a cheaper car because I feel like you're screwing me over. So let me know if that's a trend you're noticing as well. Now, let's also look at the days of hand supply by brand to see if we can reconfirm this affordability trend. The ones in red are GM brands, the ones in blue are Ford brands, and the ones in black are Stellantis brands, which is also Fiat and a bunch of other brands in Europe, but they have American brands. So Cadillac, Chevy, and GMC are GM brands, and Buick as well. You can see that Cadillac and Chevy is much closer to the 60-day average. Actually, they're below it, so those two brands are actually doing quite well from an inventory perspective. GMC, which is mostly selling pickup trucks, is slightly above the 60, and then Buick is I don't know what they're doing at Buick, so we'll put that aside. Ford and Lincoln, which are primarily really pickup truck and SUV dominated, they're much higher. They're at about 70, and then Lincoln is closer to almost 90. And then Ram, Chrysler, Jeep, and Dodge. Ram and Jeep, a lot of pickup trucks and SUVs. Chrysler and Dodge, not so much, but Ram and Jeep is by far the largest brands that Stellantis have in the US. You can see that their day supply are around the 100-day mark, which is a lot more than 60 days on hand. And so the very interesting trend here is if you notice the brands here and you notice the brands here, right? Cadillac and Chevy, and then you have GMC, Ford, Dodge, Ram, Chrysler, Jeep, right? Pickup dominated brands are suffering. That's the common trend here. Ford, Ram, GMC, Jeep, all these brands are primarily dominated by pickup trucks and SUVs, and they're all having a lot more supply on hand. Yet the brands that don't sell that many pickups, Chevy and Cadillac, have a lot less on-hand demand. And you can see it across every single brand as well if you want to pause this slide and take a look at it. Pickup dominated brands are suffering, and pickups, again, are way more expensive than your typical vehicle. Ford and Stellantis, obviously from this trend, need to adjust prices to really lower their days on hand supply to get into a more affordable arena for people, but we'll have to see if dealers and the brands can afford to do that. And then it appears that GM is actually managing inventory quite well versus its peers. They're right around that 60-day mark with at least Chevy and Cadillac, and then GMC is slightly higher, and then Buick is a whole different story. But overall, they seem to be managing inventories very well. But one of the reasons that could be is that GM sells more affordable cars than Ford or Stellantis. They have a much broader lineup, and they sell a lot more than just pickup trucks and SUVs. The GM average selling price based on their Q1 earnings report, this is global, but you can also think about this in the US as they have the Malibu and the Trax and the smaller vehicles, the Equinox, things like that are more affordable. The GM average selling price to the dealer is about $29,000, where Ford's is upwards of $40,000 and Stellantis is significantly above $40,000. So this $10,000 gap might not seem very big, but it's actually quite significant, especially when Ford does a lot of vans for commercial vehicles, which are not really used by the broader public. A lot of their sales come from the F-150 and those types of cars, which are sometimes significantly higher than this 40. So this gap, I think, describes why GM is able to keep their inventories in better shape. Now, given all this data, I feel quite confident in saying that affordability seems to be the biggest trend in the auto market, especially for the foreseeable future. We're seeing pickup trucks that are much higher priced than the average selling price are selling a lot less. We have brands that mostly sell those pickup trucks suffering from an inventory perspective. We're seeing those trends in the EV market as well, with Tesla taking majority market share in a lot of markets with their cheaper price EVs. There's a broad sort of thing going on here. And especially with the Fed having the rates up at 5%-ish in the US, which makes it tougher to afford a car, it's going to be very, very important for automakers to get to a point where they can make affordable cars in the coming years. Otherwise, their market share is going to be swallowed up by those that can. So brands like Toyota, Honda, and who knows, even Tesla with their lower price EVs could benefit tremendously from having lower price vehicles. But I'd love to hear what you have to say. Let me know what you think about this data set. Do you see something in your area that might point to something else or maybe confirm this trend? And if you want to see more videos from me, I would love it if you subscribe right below this video. And if you want to support this video or this channel rather, I have some merch in the description below. You can follow my link to my website to purchase some merch. Thank you so much for watching. I hope this video was informative and helpful, and we'll see you on the next one. Take it easy, everybody. Bye-bye.